let's get on with the topic for today. I hope you have taken down the handouts. There were two handouts. One is on books of prime entry and the other one was bank reconciliation. So we will start with the books of prime entry. Any questions with regard to what we have done so far? If you want to clarify anything. Are there any questions that you want to clarify? Or you can send it as a message also in the portal. Right. So let's get on with the topic today, where we are going to look at the books of prime entry. So we have prime entry and of course the journals. So we started looking at double entries, double entry principles, the accounting equation. So here onwards, it is very important that you understand the double entry principles, because for anything that we are going to learn from here, you need to always visualize and also understand what is the double entry, underlying double entry for every transactions that we may talk about. So it's very important that the double entries are understood by you all. Okay, right. So what we are going to look at today is where certain transactions pertaining to business organizations have to be initially entered into a set of books. We have to enter them in a set of books where we call them as the books of prime entry. The books of prime entry. So this is like where it comes from is from the traditional bookkeeping, right? When we say traditional bookkeeping is where most of you might have not seen it, where businesses maintain books like either it could be CR books or many exercise books or maybe some other larger books where we call them as ledgers. Those type of books were maintained to enter transactions, right? But now today what has happened is even a small grocery shop where you might enter into might have a computer, right? So your transactions are captured electronically, unlike earlier where the transactions were recorded manually in a set of books where people, one person named as the bookkeeper or the accountant will sit and write all the transactions one by one, right? And for each of these transactions, they will go and enter into an account, So what is this account is that we have already seen, right? So the account will be the T account that we were talking about. So that is the history of the books of prime entry, where the transactions originated in a business concern is entered in a set of books where the bookkeeper or the accountant will go and enter transactions into different pages of a book which are designated with individual accounts, right? But in today's context, we know that the books of prime entry are little by little dying because people are much more conversant and familiar with the use of computers or systems to record transactions, one of the primary reasons for doing such change was with the improvement and the enhancement in technology. And also, one of the important factors was the growth in business volumes and transactions. Because day by day, the business volumes and the transactions are growing in business concerns. So it is a very tedious or difficult task for the bookkeeper or the accountant to enter transactions into these books, right? But having said that, still there are businesses who are following that also. So it doesn't mean that it has already gone out of the practice. No, certain businesses, they make use of these prime entry books, and most of the businesses have computerized their bookkeeping. We call it as bookkeeping, right? So what we are trying to learn here is the traditional way of bookkeeping. That is why we call it as prime entry books or the journals. How to maintain records, accounting records in your business. Okay, right. So the starting point for same is to understand what is a cash transaction and what is a credit transaction. Okay. So as we know, cash transactions will be where people or the buyer will choose a particular good to be purchased and they pay for the goods immediately in monetary terms using the notes and coins. So for example, you go to a grocery shop, you buy something and you pay cash. You pay cash. So when you immediately pay cash for the goods purchased, that is considered to be a cash transaction. That is considered to be a cash transaction. Then what is a credit transaction? Credit transaction is where people again select goods to be purchased, but with the understanding with the seller, you may need not pay immediately. You may pay or need not pay immediately for the goods that you have purchased. So the arrangement with the seller is to pay for the goods on a later date than the delivery of goods. So what do you mean by delivery of goods is, like say you pay today, like for example, you go to Abans and you would like to purchase a refrigerator. So when you purchase a refrigerator, what happens? You may not be immediately in a position to carry it and take it home. So what happens? Later on, they will deliver it to your doorstep. So what will happen here? You will pay today and go home and the goods will be delivered. That is where a cash transaction is. But what do you mean by a credit transaction is where you agree to purchase today, you enter into an agreement, but you will not pay today. You will pay a date which is later than the delivery of the goods. Okay, so that is what a credit transaction is. Now let us try to understand. I would like to explain this on the board. Because this is the basic that you need to know. Right. Now let's say there is a seller and there is a buyer. There is a seller and a buyer. So what is going to happen between these two parties? There is going to be an arrangement where the buyer agrees to purchase a good and the seller agrees to sell a product or a good. So basically there is an agreement. Right? We are not looking at the cash transaction, we are looking at a credit transaction. Now under this agreement, what is going to happen? You agree to purchase a product, but with the consent of the seller, you agree that you will pay for the good or the product at a later date. So now what is going to happen? The product will be delivered. The product will be delivered. But what is the agreement? What is the underlying agreement? The agreement will be you will pay this seller within 90 days from purchase date. Now this is the agreement. You will agree to pay within 90 days from the date of purchase. From the date of purchase. So if you have purchased today, from today you agree to settle this amount within 90 days. In between, the product will be delivered. That is not relevant. That is not relevant. So I take this purchase, date of purchase to be, let's say 1/1/2021. Okay. The product is delivered on, let's say, 5/1/2021. But what is the requirement here, or rather the agreement? I will agree to pay on or before 31st March 2021. You see? You are supposed to settle this person, the seller, on or before 31st March 2021. So which means roughly the 90 days. 90 days. When this sort of a sale takes place, we call that to be a credit transaction. Credit transaction. This is a credit transaction where there is an agreement between a buyer and a seller to purchase a product. It could be a service, whatever, but the payment will happen at a later date than the delivery of the product. Now this is the agreement, but if this person likes to pay, say on 10th of January, there is no restrictions for that. You can always go and settle it on 10th of January. There is no issue. This person will accept it. But what does the agreement says? You can't delay this payment more than 90 days. That is, if you go and pay, if you don't pay within 31st March and you are trying to pay it later, then there will be legal consequences. Legal consequences. This is what arrangement for a credit transaction. For a credit transaction. Can you take down this? If you have any questions, please ask. You all can see the screen, right? Below that you can write in this particular transaction, in this particular transaction, in this particular transaction, in this particular transaction, the buyer and the seller, the buyer and the seller enters into an agreement, enters into an agreement for the sale of a product, for the sale of a product, for the sale of a product, where the payment obligation, the payment obligation is allowed a time period, is allowed a time period. The payment obligation is allowed a time period. In this case, it is 90 days. It is 90 days from the date of purchase. From the date of purchase. Next line. Hence, this is known as a credit transaction, or a credit sale, or a credit sale. Next line. Similarly, people can enter into agreement. People can enter into agreement. People can enter into agreement for credit purchases as well. For credit purchases as well. Next line. In both cases, the time period offered, for payment, is known as credit period, or credit term. Credit period or credit term. So this transaction can be simplified. Let's look at it like this. Now, let's take the seller to be, I'm just taking an example. Let's take this is to be Abans. So you go to Abans to purchase a refrigerator. So you are the buyer. So you enter into an agreement. You say that I want to purchase this product. Right? Now what has happened? For the payment, you can agree into terms. Either you can pay with your credit card. Now there are instruments available. You can use your credit card so that you can automatically get the credit period for the payment. That will be offered by your bank, not by the seller. That is one way of doing it. Now, the people have gone to another step where, or the sellers also have utilized that option. They go into 0% interest plan. What do you mean by that? You offer a term period where the purchase price is broken down into small parts and you pay it over a period of 12 months, 20 months, 36 months, whatever. So the term is offered in terms of the credit card payment. So there also you are getting a credit term or credit period. But this is like one of purchases that we are talking about, right? But the subject matter that we are discussing here is not that. Where businesses will do sales on credit terms. People will come, they order for goods, they buy them, and they settle like during these periods as they like. So different buyers will have different term periods. Some person will have 60 days, some person will have 90, 120, depending on this person's capacity. If he doesn't want cash coming in immediately, he can offer. Why he wants to offer? To encourage people to buy more. So that is what a credit transaction is. So let's look at the purpose of the prime entry books. The purpose of the prime entry books, right? So with the backdrop of a cash versus credit transaction, we are now going to look at why the prime entry books are required. So prime entry books are the books that will be used to record all the T accounts of a business, all the T accounts, right? For any purpose, if you want to have an income or an expense or an asset or a liability or equity, whatever you may call it, it needs to go through a account. So we generally call this account to be a T account, T account. So why prime entry books are required? That is to record all the transactions of a business through an account of the business. And where these T accounts are sitting on, it is in the prime entry books. It is in the
Sir,
yes.
is the installment type is also come under the credit transaction?
Yes, because now installment is actually you are dealing it with the bank, right? Not with the vendor. Now, even if you go to the Abans or buy some product, Abans will get the payment from the bank immediately. So actually, the credit term is working between you and the bank. Why? You are settling the your card. You are talking about the installment plan in a card, right?
Yes, sir.
Yeah. So the transaction is automatically translated into between you and the bank. Right? Now in those type of a yes, very valid question that you asked. Good. Now, the question that person asked, now that is a tri-party transaction, right? That is a tri-party transaction. Now this is you. Let's say this is a branch, and this is your bank, right? So you buy from Abans will deliver the product, right? And they have a scheme. What is the scheme? If your bank has agreed with them to offer a 0% interest plan, that is installment plan, they will offer it to you. So what is happening? Your credit card is getting promoted. So you make use of this card, your bank card, and enter into this transaction. Right? Let's say this is 100,000. This is 100,000. Right? Payable in 20 installments. Right? 20 installments. I'm just ignoring the interest factor. So when you enter into 20 installments, your installment will be 5,000. Right? 5,000 each. Now what is going to happen? You purchase a product from Avans, they will deliver it to you. At the time of the purchase, you will give this card. So they will mark, and then you need to sign a agreement document which says that you have entered into a 0% installment plan, and you will go back home with the product. Later on, what will happen? Your bank will settle this. Your bank will settle this 100,000 immediately. Now, the agreement gets translated between you and the bank. Right? What the bank will do, every month, they will bill you with 5,000 rupees. Every month you will get billed. If you look at a credit card statement, you will see. They will say, first installment of 20. Then the second installment of 20. Another 5,000. Likewise, this will go on to 20 months. Right? It is your option that whether you want to settle this before the due date or not. If you settle it, there won't be any interest charge. If you don't settle it, there will be interest charge. So, ultimately what has happened, the transaction that you entered into with Avans now has got converted with your bank. Okay? But this is again a credit term or credit term sale. But only issue here is you are going to make a payment on a monthly basis, or you agree to make a payment on a monthly basis with your bank. Whether you like to pay it or not, it's your call. Right? So agreement is that they will allow you to pay 5,000 each on a 20 months basis or 20 installment basis. Have I answered your question?
Yes, sir. Thank you.
Right. Good question, actually. Right. So getting back to the presentation. So you will record all the transactions in your T accounts dedicated in the dedicated prime entry books. Right. So as I told you earlier, the expansion of the business, the increase in transaction volumes, the number of T accounts also have increased. Now, say for example, if your bank has 2 million customers, let's take individual 2 million. If your bank has 2 million depositors, what does it mean? Each individual will have one account. Okay, which means your bank will have 2 million accounts in your computer system. Just imagine if you are to maintain these 2 million accounts in a set of books where you have to write every transaction that you do with these customers. And in today's context, any customer can have any number of accounts. It's not only one account per customer. So just imagine increasing the number of accounts will get into more and more trouble for you to maintain these records in books. Okay, that's why today banks and most of the companies have moved into the computerized systems, right? So it could be a question. It can be asked as a question in your examination. Why businesses today looking at computerizing their business transactions? So purely it is because of the expansion of businesses. With the expansion of businesses, business volumes and transaction volumes have increased. As a result, the number of accounts to be maintained also have increased. And this is a cumbersome exercise to maintain in manual books. Therefore, most of the businesses have computerized their, business transactions are now computerized. So, the T accounts are now going to be classified into 3 ledgers. We call them as 3 ledgers and 7 books or 7-day books. We call them as 7-day books. These 7-day books are what we are trying to establish as books of prime entry or books of original entry. Okay, so there will be 3 ledgers. On top of that, you will have 7-day books. 7-day books. That is what we are going to learn under this chapter. So what are the 3 ledgers? For any business concern, there could be mainly 3 ledgers. One is known as your sales ledger, where you will capture all your sales related transactions. All sales that you do with your customers will be captured in the sales ledger. Purchases ledger is all purchases that you do on behalf of your business will be recorded in the purchases ledger. All other transactions pertaining to your business will be recorded in the general ledger. So basically, there are 3 ledgers: sales ledger, purchases ledger, and the general ledger. Your accounts, or in other words, the T accounts, will be captured under these 3 ledgers: sales ledger, purchases ledger, and the general ledger. So, when you are looking at the prime entry books, we need to understand how we can record a transaction. How we can record a transaction. What is our requirement? Now, let me ask you a question. Now, most of you might be working in banks. So, if you are a person doing a transaction, being in the counters, that is working in the bank counters, right? And you are getting a customer who wants to deposit 10,000 rupees into his savings account, right? Now he comes and gives you 10,000 rupees. Will you perform the transaction? What can you say? Can you perform the transaction?
No,
What do you say?
they need to fill the slip.
They need to fill in the slip. What is that slip is called? That is a deposit slip. Am I correct?
Yes, yes.
That is a deposit slip. Now, tell me why you would want that? Why you want that?
That is a physical evidence to prove the transaction.
Ah, you are using a very important word there. That is the evidence. Evidence, you see? So, when you are performing a transaction, it is very important that you need to have evidence. This evidence can work both ways. Evidence could be for your business or for your bank, or it could be for the customer. It could be for the customer. Now, this deposit slip that the customer brings in along with the cash will work as the source document for the transaction. You all understand that? This deposit slip given by the customer will be the source document for the transaction. We call it as the source document for the transaction. So this source document will have the details. Now anybody can bring in money to deposit. But as a banker, you should know to which account I should deposit this money. So just because somebody brings in money and gives you, you can't just deposit the money to his account. It has to be with the evidence that you need to perform the transaction. So that is why you require this person to fill in the deposit slip with the particulars that you require. What are the requirements? Probably you will look at the date of the transaction. You will look at the account of the transaction. You will look at the name of the account holder and the amount in the deposit slip. Probably you also will look at the signature of the deposit. Right? This is something that you practically do. So it is very important that you need to have a source document for a transaction. Now, similar to that, in every business concern, when you want to enter a transaction in your prime entry books, you need a source document to record that transaction. Okay? So, like you accept a deposit in your bank, like you do a withdrawal where the customer is required to fill in a withdrawal slip. Now, of course, most of the banks do not encourage people to come and withdraw money from the counters. What do they want? What do they want them to do? What does the bank want them to do?
Get from the ATM.
Yes. Withdraw the money through your ATM if it is not a large sum. Why? Then you can maintain the bank counters without much crowded. Because rather than people coming to deposit, the withdrawals might be more. So your counters will get more crowded. In order to avoid that, what banks are today doing, they are diverting their customers to either digital channels or like these ATMs and CRMs. Okay. So while you are learning this accounting subject or any other subject, you need to have a little bit of flavor on the general banking side also. Okay, that will help you to understand some of the things that we learn, right? So coming back to this subject, for every transaction that you perform, even it could be your bank or even it could be any business, you need to have a source document. Every transaction have to be backed by a source document. That is what we are trying to establish. So what is the usefulness of these source documents? Now, the source document will be the basic document that you will make use of for the transaction. It acts as the proof, or in other words, somebody said evidence for the occurrence of the transaction, It acts as a basis to record the transaction in the books. Now today you record it in the system, computer system of your bank, but generally businesses recorded it in the prime entry books, one of its prime entry books. Here are some of the basic source documents that you might come across. Now for a bank, you will see a deposit slip will be there, a withdrawal slip could be there. When you want to do a purchase of stationery, you need to have an invoice from the supplier. We call it as an invoice. Now, if you are to make an electricity bill payment, what is the source document? For an electricity payment, what is the source document?
The electricity bill.
The electricity bill. That is the source of evidence for you to initiate the transaction. Very simple. When you go and withdraw money from the ATM, what is the source document?
ATM card.
No. ATM card, of course, is required for you to do the transaction.
The
PIN
slip
number,
which you are
PIN
getting after
number.
the transaction.
Pardon?
PIN number.
No. Those are like what you need to require. Like
The
I'm
slip
asking
which
about the
we are
source
getting.
document for the transaction
Excuse-
or evidence of the
The slip
transaction.
which
The slip.
we are getting
What
after
is it? The slip.
the transaction.
Yes, the withdrawal slip that you get. Now what has happened? The banks have given an option whether you want a receipt or not, isn't it? People have a choice whether they want to have a slip or not. So if somebody selects that they want it, they will get the slip, but on the other side they will be charged. So as a result, people today don't want the withdrawal slips, right? And most of the cases, what happens? They will look at through the digital platforms. Sometimes people have internet banking, or sometimes they have certain apps in their mobiles to look at the transactions. So people are little by little getting digitalized. So this concept of source document, having papers physically, is little by little dying. Now in today's context, under the pandemic of COVID-19, what has happened? Most of the businesses have gone into e-invoices. Have you heard of e-invoices? Have you heard of e-invoices? Where you will produce an invoice which is not signed physically. It is a digital signature, right? That digital signature will work as the source document for the transaction, right? So the globe is little by little getting into fully digitalized. as a result, actually, the purpose of maintaining prime entry books is getting evacuated from the business world, right? But this being a subject matter that we need to learn, we are learning here, right? Okay, books of original entry. So as I told you, there are 7-day books or 7 books of original entry. What are those known as? The cash book. Then we have the petty cash book. Then we have something called sales day book, purchases day book, sales return day book, and purchases return day book. And finally, you have the general journal. We call it as the general journal. That is also one of the day books that you have to maintain in your business. Maintain in your business. So these 7-day books also falls into the 3 ledgers. Falls into the 3 ledgers. What are the 3 ledgers? The sales ledger, the purchases ledger, and the general ledger. Okay, so these 3, the accounts coming under these 7-day books will go back to the 3 ledgers that we talked about earlier. So it is very important to know these 7-day books, right? Even you might not sometimes practice these in the real business world, but for these examination purposes and for your knowledge, you need to have it, because sometimes your businesses that you are going to evaluate, right, for loan applications, for various purposes, might have these types of accounts in your customers. So we need to know that. So basically, we are going to classify the transactions like this. Okay. As I told you, you can have a credit sale. Similarly, you can have a credit purchase. You can do a sale, you can do a purchase. And we also have something called return inwards. Return inwards. And we also call return outwards. Return outwards. Then we have cash and check payments, receipts and payments. Now there are payment modes where you can pay by cash or you can pay by using your checks. And apart from those, you can make any other payments or any other transactions you might have in your business. Right? So let us try to understand that first. So what we are trying to say here is, now in a business concern, I'm going to divide it into 3. You have sales, right? You have purchases, and you have other transactions. So you have sales transactions, you have purchase transactions, and other transactions. Now, what do you mean by sale? You sell a product. Or you can sell a service also. Let's take a product, that will be easy. You purchase a product. Right? Any other means you obtain services. Obtain services. Or let's keep it like that. Now, what is important here is the sales that you perform is going to be on credit. Why we are talking about prime entry books is because of that. If you are doing a cash sale, there is no argument about anything on the prime entry books. Prime entry books will not come into the picture. Why we are talking about prime entry books is because those transactions are on credit terms. Similarly, purchases, when they happen on credit terms, it will come into the day books. Right? All the other transactions that may happen on cash or maybe using the credit card, whatever you may call it, go under other transactions. Right? So, when you do a sale on credit terms, that we call it as a credit sale. Credit sale. You do a purchase here, that a credit purchase. Now the question here is, where will you record this credit sale? That goes into the sales day book. So the credit sale goes into the sales day book. Credit purchase goes into the purchases day book. So what do you mean by that? Here you sell something, here you buy something. Okay. Now both these instances, we are looking at it from the point of view of the entity. That is what you have to remember. Always we look at it from the point of view of the business. Because that is what business entity concept is. Business entity concept is what? The owner and the business is looked at separate, or the business and the customer is looked at separate. So every transaction that you will learn under this course or for your examination always have to be looked at it from the business point of view, not the individual who is doing the transaction. So when there is a credit sale, my transaction will be recorded in the sales day book, in the sales day book of the business. When the business is entering into a credit purchase, it will be entered in the purchases day book. Right. Now you have done a sale, you have sold a product, right? Now the payment is not yet made by the buyer. In between, the person who bought the goods from you comes and returns it to you. That is very obvious. We also do it. Sometimes we go and buy a product, but by the time you go and open it at home, you see that it is broken or damaged. Then what do? You will go back and return it. You will go back and return it. Right? Now, if it is a cash sale, of course, when you go and return it, what the person will do? Either they will give you back the money, or if you prefer to buy some other product, they will for that and they will offer you that. But now in a credit sale, there is a problem. When it is a credit sale, we need to now cancel that credit sale. Cancel that credit sale. So what do we do? What do we do? Now we have to look at that. Return of credit sale. So the credit sale that you did is now getting returned. So that is recorded in a separate book. You don't go and touch this book. That is called return inward. Returns inward day book. We call it as a returns inward day book. Or you can call it as the sales return day book. I think this is not there in the handout, so you can write it down if you want, or you can take down this entire thing for your reference. So when a return happens of a credit sale, you need to go and cancel that sale. How you cancel it? You don't go and tamper it with this book, because this is where you recorded your credit sale. Now you don't go and cross it, saying that the sale is cancelled. No, I will keep it as it is, but I will go and record it in a separate book, which is known as the returns inward day book or sales return day book. Similarly, you do a credit purchase. Let's say you purchase stationery for your business. You go and buy A4 bundles or A4 packets for your business. That is to print invoices and so on for your business, to be used in your business. But after getting down the stationery, you observe that most of the papers are all torn. So you don't want to use it. You will go and return it. So what is that? Return of credit purchase. Return of a credit purchase. So like you entered the credit purchase in a purchases day book, when the return happens, you don't go and cancel it here. You need to enter it in a separate book called return outward. We call it as returns outward. Or we can simply call it purchases return day book. Purchases return day book. So when you do a credit sale, you enter it in the sales day book. When you have a return of a credit sale, you enter into a returns inward or sales return. When you do a credit purchase, it is entered in the purchase day book. When there is a return happens, it is recorded in the return outwards or purchase return day. All the other transactions happen or recorded in the general ledger other than these two ledgers. So here you can have the cash book, the petty cash book, and the journal. Okay, you can take down this. Take down this for your records. So what you can do is, I don't know whether if you are using your mobile device, you can have a screenshot, or if you are using a laptop, just have a print screen or take a photograph of your mobile from your mobile, so that you can write it down later on into your exercise books. Okay, right. So let's get back to the presentation. So now you know that how these books are segregated, right? So when there is a credit sale, you know that is called a sales day book or sales journal, whatever you may call it. It means the same. So when it is a credit purchase, it is the purchaser's day book or the purchaser's journal. You can also call it as a purchaser's journal. Returns inwards or sales return. If you have the slide deck printout, just mark it as sales return. So it goes into the return inwards journal or return inwards day book. Then you also have return outwards, that is the purchaser's return. So that goes into the purchaser's day book. Then when you look at all the other transactions, it can be grouped into two or classified into two. One is where you look at the cash and check related receipts and payments. So that will go into the cash book and the petty cash book. All the other transactions other than the 5 that we discussed so far will go into as the general journal, that is the last day book. So altogether there will be 7 day books: sales day book, purchases day book, sales return day book, purchases return day book, cash book, petty cash book, and the general journal. So ultimately, the double entries originating from these 7 day books are entered into the 3 main ledgers. We call it as the sales ledger, purchases ledger, and the general ledger. Okay, sales ledger, purchases ledger, and the general ledger. So sales ledger will have a lot of accounts, purchase ledger will have a set of accounts, general ledger also will have a set of accounts. And these accounts are known as control accounts. Control accounts. Please make a note of it. The accounts that you maintain in the 3 ledgers are also referred to as the control accounts. So why you say control account is because the detailed accounts are maintained in the day books. Okay, the day book will have the details, and the control totals will go into the 3 ledgers. 3 ledgers. And this is a snapshot of the source documents that you may require to perform transactions in the respective day books. In the respective day books. So look at the source documents. So for a credit sale, you will have the sale invoice and you will enter it in the sales day book. When there is a sales return, you need to give a credit note. You need to give a credit note, and it will be recorded in the sales return. When you do a credit purchase, you require the purchase invoices, and it will be entered in the purchases day book. When there is a purchaser's return, you will receive a credit note or you will get a debit note, which is also known as a debit note, and it will be entered in the purchaser's return day book. Receipt or payment of cash For that, you need a receipt or payment voucher, and it will be entered in the cash book. All the petty cash expenses, please note that it is all expenses. So petty cash book will hold all the expenses. And for those, the source document is petty cash vouchers. We call it as petty cash vouchers, and it will be recorded in the petty cash book. For all the other general transactions, you will have some sort of a documentation, which we call it as the financial correspondence, like the electricity bill, the telephone bill, whatever. And it will be through a general journal that you will originate the double entries or enter it in a general journal. Now, every business concern will have a classification of its T account structure. So as I told you, you will have thousands of millions of accounts. It doesn't matter. But it can be broadly classified into two categories. One is known as the personal account. The second one is known as impersonal account. Impersonal accounts. What do you mean by personal accounts is any individual's account, like say Mr. Pereira, right? ABC company, XYZ company, all those are personal accounts. In other words, with whom you might do sales or with whom you might do purchases. Those accounts are known as personal accounts. Any other account that you will have in your business is known as an impersonal account. An impersonal account. So all the personal accounts will reside in your sales ledger or the purchases ledger. Sales ledger or the purchases ledger. And it will also have the control accounts. The control accounts. The impersonal account means we again classify them into two broader categories. One is known as the real account, the other one is the nominal account. Real account means all your assets and liabilities. Nominal account means it will be your income, expense, and all your capital. And all your capital. So again, so we are going to look at three categories, right? So here we call it as personal accounts. And this is impersonal accounts. impersonal accounts. Personal accounts and impersonal accounts. Okay. So under the personal accounts, we have sales related and purchases related. Sales related and purchases related. Right? So when you do a credit sale, let's say you do a credit sale, you do credit sales with Mr. X, ABC company, let's say Herrera and Sons. We are just taking some names. ML printers, let's say. Right? So you are doing sales with all these people. You are doing sales with all these people. Now, from the business point of view, this particular business will have accounts in the name of Mr. X, in the name of ABC company, in the name of Pereira, and in the name of ML printers. Individually, you will have accounts like the T accounts. T accounts you will have, right? So when you have the T accounts, all these people that with whom you are doing credit sales will be known as, this name is very important, debtors. Please remember, when you are as a business concern, when you are doing credit sales with your customers, all these customers will be known as debtors as far as the business is concerned. As far as the company is concerned, all these are my debtors. Then I will do some credit purchases. Credit purchases, where I will go and buy things from various people. Right? PQR company, TD Brothers, I'm just taking some names, let's say LMN company. So with all these people, when you do transactions, you will have individual accounts. So here, you are supposed to receive money. From the business point of view, you are supposed to receive money. Here, you are supposed to pay money or pay cash or whatever. Under credit terms, you need to pay. So here, when you are supposed to receive money, you call them as debtors. For the people who are supposed you have to pay money are known as creditors. So please try to understand these two important categories of your business. Debtors, the people who have entered into with you a credit sale. So they are supposed to pay you money at a later stage. I am supposed to receive money. Creditors means with whom the business has entered into purchase transactions on credit terms. So for those people, the business has to pay at a later point. Okay. So debtors is basically one of your assets, and the creditors is one of your liabilities. Apart from these two, we have the impersonal accounts. Impersonal accounts. So here again, we have the real accounts and the nominal. Now here we talked about an asset and a liability. So all other assets and liabilities of your business are here. We never spoke about an income or expense here. All those come here. Say for example, your interest income, commission income, like expenses, electricity, water, telephone, rent, anything can come under nominal account. All your assets and liabilities like cash, property, plant and equipment, taxes payable, right? Liabilities, short-term liabilities, everything will come under, right? In addition to that, one other aspect which is not covered is your capital account. Like the stated capital, share capital, everything is here. Okay? Can you take down this? Okay. Hope you would have taken down. Right. So now let's look at the sales journal, right? So this is how the sales journal or the sales day book will look like. Now, what are the information that I need to fill in? Like this is like a page. Huh? This is like a page. Like you will have several pages. In that, you are going to record. So first thing, you have the date. Then, when you do a sale, credit sale, you will issue an invoice. So that invoice number should come here. Then, the buyer, name of the buyer. Now here in this case, I took Mr. X, ABC company, Ferrer and Sons, ML printers, all those will come there. Then you will have to give them a description, like what they purchased. You might have sold grocery, you might have sold stationery, whatever, what you sold to them. Then you have to mention the quantity, how much you sold. Then the unit cost. How much is one packet? Or how much is one bottle? That you have to put. Then multiply that by the quantity. Then you get the amount. Then you have to put the total amount, which is like the running balance of yours. Then the last column, you will have to refer it to your ledger. You have to refer it to your ledger. What is the ledger now? In the sales ledger. In the sales ledger. Okay. So that is what we are trying to establish here. You will have to have the total coming here, and that total will get transferred to your ledgers. Respective ledger, you will transfer it to the respective ledger. So transferring it to the respective ledger can happen on a daily basis, or it could be on a monthly basis. But we should not have long durations, because if there are errors, then you might not detect those. So it is very important that you do on a timely manner, transferring from the day books to the ledger accounts. That is very important. Now, look at these. When you are transferring, what is the double entry? What is the double entry? So you will take the total from the previous, what here it says transfer to sales account. You take that total and you will debit an account called debtors account with the total. And the credit goes to, as I told you, it goes into a general ledger where your income, expense, everything is located. So you see, your debit is to the sales ledger where you have an account called debtors account, and the credit goes to the general ledger, which is the sales account. Right? So let me show it here. Now here, when you do the sale, what are the debits or the double entries? You will debit the debtors account and credit sales account. This is what you are, and you will have the total amounts. Okay. So look at the account structure. The sales output is going into two accounts. One is the debtors account, the other one is the sales account. So debtors account is in your sales ledger, sales account is in your general ledger. This is your general ledger. Okay, is that understood? Then the next item is your sales return. Sales return. You see, now you did a credit sale. Now it is getting returned. Now see where we go and put it. Right? Now you did a sale. Now that sale is getting returned. So when a sale is getting returned, what does it mean? Now you entered into a sale with Mr. X, requesting him to pay after 30 days. But somewhere around 15 days are done, he is coming back to you and saying, look, these goods are not in good condition. I don't want them. So now the sale is cancelled. If the sale is cancelled, that person need not pay you. That person need not pay you. So what happens when a sales return takes place? You will debit an account called return inwards or sales return. And credit, that means you are reversing the debtor's account. In the note. Okay. So this also you can do on a weekly or a monthly basis. Whatever the total returns, you total them, debit an account called return inwards and credit the debtor account. This is where you initially put, now you are going to cancel. So again, this is in your sales ledger and return inwards is in your general ledger. In your general ledger. Okay. Now I'll go to the next step also, that is to talk about the credit purchases. So when you do a credit purchase, the double entry will be debit purchasers account and credit, as I told you, what is that? Creditors account. For the total. Okay, so here purchasers is an expense account in the general ledger. Creditors account is in the purchasers ledger. Purchasers ledger. This is the sales ledger. This is the purchasers ledger. Okay. Similarly, when a return happens, that is, you purchase some goods on credit terms and now you say that I don't want it. So you will debit your creditors and credit return outward. Return outward. Okay, return outward. So creditors is in the purchase ledger, return outward is in the general ledger. Okay, is that clear? You can take down. Any questions? If you have any questions, please clarify. Okay. So this is how the purchases day book will look like. It's similar to what we looked at for the sales day book. And this is the double entry. And this is the purchases return, purchases return. Okay. So similar to the 4-day books that we learned: sales day book, sales return day book, purchases day book, and purchase return day book. Right? Those are the first 4-day books that we learned. Now we are going to look at the most important day book in your business. That is the cash book. Cash book is the very important and primary book that you enter transactions. Why? The business is going to run with the cash that you have, right? So cash will come in, cash will go out. That is what the business is all about. So cash book is the most important prime entry book that you have, where all transactions relating to your cash is entered in this book. But with the advancement of businesses, people have opted to use the bank accounts rather than the cash book, because people doesn't want to carry cash all the time, right? So what they want to use is they want to maintain a bank account, and that will be used as part of your book for your business transaction. So in businesses, the cash account and the bank account is always dealt together. Why? Whether you say cash or whether you say bank account, it means the same. End of the day, every time you are available with the cash, right? So in a cash book, what happens? Cash book keeps records of all cash transactions. That is, you might receive cash or you might pay cash. All receipts are recorded on the debit side, and all payments are on the credit side. So when you receive cash, what do? You debit the cash book. When you are required to pay something, you will credit the cash book. Okay? Because cash is an asset. Cash is an asset. So any increases to asset will be debited, that we have already seen. Any reduction in assets will be credited to those assets. So in a cash book, whenever there is an increase in cash, you will record it on the debit side, that is the left hand side. When there is a reduction in cash, you will record it on the credit side or the right hand side. When you look at a T account, the T account left side is the debit side, right side is the credit side. And the cash book, there is a speciality where we call it as the double column cash book. Double column cash book. So the same cash book is going to be used for the purpose of recording all your cash transactions as well as your bank account transaction. That is why the cash books are generally known as double column cash books. There will be 2 columns on the debit side as well as on the credit side to record transactions from the real cash as well as your bank account. Right? So I'll straight away go on to the this is the structure of a cash book. That's why I just wanted to show you all. When you look at a cash book, These are the columns that will appear in a cash book. Go through the columns. There is a debit side and a credit side. So it ends at the center of the date column. If you really look at it, right. So you will see the cash book is divided from here. The thick black line that I am showing you. You can mark it on your handout. So there is a debit side and a credit side, left side and the right side, right? Which divides the thick line. So in the shape of a T account, you will see there is a debit side and a credit side. Now on the debit side, you have the date column, particulars or the description, the voucher number, ledger folio, we call it as the ledger folio, that is the page number of the ledger. Then you have the two important columns. One is namely the cash column and the other one is the bank column. Please make a note of it, very important. In the cash book, you have two columns, namely the cash column and the bank column. Right? Similarly, I'll come to the next column thereafter. Then on the right side, again, you will see the same columns are repeated. Date column, particulars, voucher number, ledger folio, and again you get the cash column and the bank column. So anything that you receive, when you receive cash, you will go and record it here. Right? Anything that you receive into your bank account, you will record it here. If you get some money coming into your bank account, you will record it here. Right? Any payment that you make in the form of cash, you will record it here. Where I am showing you with the mouse pointer, it will be here. Anything that you will pay out from your bank account will be recorded here. Now here comes a position where how you will pay out from your bank account. The question is how you can pay out from your bank account. Can anybody tell me? How can you pay out using your bank account? Yes, very good. That is by way of using your checkbook. Using your checkbook. So whenever you are required to make a payment using your bank account, what will you do? You will make use of the bank checkbook that is given to you. So you will issue a check in the name of so and so. So in this example that I wrote, you can issue a check to PQR company, or you can issue a check to LMN company. That is to settle the amount due to them. So any payment that you make using your checkbook will be recorded in the column on the right side where it says bank. Okay. Now my question to you is, when you record a bank related transaction using the checkbook, what is the source document that you will have to refer this transaction? What is
Counterfoil
counterfoil of the checkbook? Very good. When you write a check I don't know how many of you have seen. On the left side of the check leaf, you will have a small part where you will record the transaction details. When you draw the check, to whom it was drawn in favor, what is the amount, any other details that you want to capture. This check counterfoil will remain with the accountant to have all details pertaining to the transaction, because the check leaf will go, because check leaf you will give it to your creditor and he will take it and go and deposit it into his account, bank account. So for you, you need to have a record of the transaction that you did. As a result, the check counterfoil will be your source document. You have to remember that very carefully. For cash related transactions, you will always have the invoice or the voucher number. Okay, you will have invoices or the voucher number for all the cash related transactions that you will do. Okay, right. Now, before we go into the question given there, I want to explain one more item there. You would have seen two more additional columns mentioned in the cash book. One is known as the discount allowed and the other one is discount received. There are two more columns. Now we need to understand what those two are, right? What those two mean for. So what is the discount? Discount can be classified into two. We call them as trade discount. The other one is the cash discount. Trade discount and the other one is the cash discount. Cash discount. So what is a trade discount? A trade discount is a discount given by the seller to the buyer as a deduction in the list price of the commodity. As a deduction in the list price of the commodity. Whereas a cash discount is a deduction in the amount of the invoice allowed by the seller to the buyer in return of immediate payment in cash. Immediate payment in cash. Now this trade discount and cash discount has to be understood properly. Okay, that is very important. Right. So now you are the business. Or you will be the seller. Let's take this scenario, you are the seller, right? And you have a buyer. Or let's say this is ABC company. Right? Now your business is to sell products. Let's say you are a seller of computers. You are a seller of computers. Right? Now he is a buyer who comes and purchases computers from you in bulk. In bulk. When you say bulk, you know what is it? Large quantity. Right? So normally your computers are priced at, let's say, rupees 120,000. Right? We call this as the list price. List price. You have to remember. List price. When you step into the showroom, when you step into the showroom, you will observe that there is a price put in the product. So in the computers, you will see price is 120,000. Now this person comes to your company and asks, look, I want to buy 50 computers. So 50 computers is a large amount, right? Large quantity. I want to buy 50 computers. Do you have in stock? So this person is asking, the buyer, ABC company is coming and asking from me. I'm saying, yes, I have 50 computers, I can give you. Then he is asking, what is the price? Each priced at 120. Each priced at 120. So now this person is not very keen to buy it at 120. He says, look, I am buying 50 computers from you. Can't you reduce this price? Can't you reduce this price? After a little thought, as the seller, I say that, okay, since it is a large quantity, I'll give this at rupees 110 each. 110 each. So now this person agrees to buy this. 110, he thinks it's a reasonable price, so he is agreeable to buy the product or the computers, 50 computers, or let's make it 100,000. It'll be easy. Let's make it 100,000. Right, 100,000. So he has reduced 20,000 since he is selling 50 computers. He has reduced it by 20,000. So now the product which was 120 is reduced to 100,000. Right? Now you tell me whether this is a trade discount or a cash discount. What is this? Trade discount or a cash discount?
Trade discount.
It's a trade discount. This difference you have to clearly understand. So what do you mean by a trade discount? Trade discount is a reduction offered by the seller in the list price. We call it as the list price. If I give you a discount in the list price, that is known as a trade discount. Trade discount. Okay. Now, so you have understood clearly what is a trade discount is. Now you need to know why a trade discount is given. Trade discounts are given to attract people to buy more in quantity. Now if this person comes and asks for one computer, give me one computer at 100,000, he will not agree. That is what we do now. When we go to the mobile shop or maybe say to buy any electronic equipment, We don't go and buy bulk, we buy individual. So that's why we don't normally get a big discount. But when you are doing a bulk purchase, we call this as a bulk purchase. There is a tendency by the seller to offer you a discount from the list price, which is known as a trade discount. Okay. Now we look at the second type of discount. So I am going to expand this example further. So now you have agreed to buy it at 100,000. Now this person asking this seller, okay, now according to this, I need to pay you 5 million. Am I correct? 100,000 each. Yeah, 5 million. Okay. Can you give me a credit period of?
Excuse me, sir.
Sorry.
Sir, is this a bulk purchase or sales purchase?
I didn't get you.
Is this a bulk purchase?
Yeah.
Bulk sales?
So no, bulk purchase or bulk sale, you can, from his point of view, the business point of view, it's a bulk sale. For this person, it is a bulk purchase. Am I correct? So from the business point of view, why I offer this is a bulk sale, yes. Right? But I encourage the people to buy more and more from me. So that's why I call it a bulk purchase. For this person, it is a bulk purchase. For the business, it is a bulk sale. Okay? Right? Because I am going to sell more in large quantity. So for me, it is a bulk sale. But for this person, it is a bulk purchase, isn't it? Right? But we are talking about from the point of view of the company. So now, ABC company has to pay 5 million and this business agrees to give 90 days credit. 90 days credit. So that sale is done. He will take the 50 computers with him, agreeing to pay within 90 days from this purchase. Okay. So let's say 1 month gone. 1 month gone. Still this person has not come to make a payment. 2 months gone. He has not come to make a payment. Now this person is little scared. He wants to see that somehow he gets the money. Right? So he wants to encourage this person to come and pay without waiting till 90 days. Okay? Now how can I attract this person? Now I am going to offer him something where he is more attracted to pay me in advance. Right? So what happens is, generally in businesses, this is offered upfront. We offer it upfront. How it works, you see. I offer him 90 days credit, but with a condition. I will say, if you come and settle me within 45 days, I will give you a discount of 1% of this. Right? What is the condition? Yes, I will give you a credit period of 90 days, no problem. But if you come and pay me within 45 days from today, I can give you a 1% discount of this amount. 1% discount of this amount. Now, it is a matter for this person to decide whether he would like to enjoy this discount. If he wants to enjoy this discount, he has to pay within 45 days. If not, you can wait for another 45 days and pay the fine in here. Now the question is, what is this discount is? That is a cash discount. Cash discount. So you see the difference between the trade discount and the cash discount. Why I offer a trade discount is to attract the buyer to come and purchase more in quantity. Why I offer a cash discount? To attract this person or to encourage this person to come and make the payment early. Come and make the payment early. So this can happen in the case of a credit sale. Because cash sale, there is nothing like this. Because you are going to pay it immediately. Okay. So when you go to shops, you will see cash price, normal price. So what you mean by cash price is actually they will try to collect the cash immediately from you. So they will give a reduction in price and give you. But really, the cash discount is offered to encourage the buyer to come and pay in advance rather than waiting till the full credit period. Okay. That is what cash discount is. Okay. So the time is up. You can take down this and we will continue from there next week. But before you come, please do revise what we have done. Next week, we will finish off this and then we will get on to the new topic that is on bank reconciliation. Okay, so we are going at a right pace, but if you think that I am too speed, you have to tell me. I don't think that I am going too fast. So let us try to finish off this next week. You can take down this and please do revise all what we have done. Okay, so let's meet next week.